Hey there, everybody, and good afternoon. Josh Cantwell here with Strategic Real Estate Coach and Freeland Ventures. Thanks to all of you who are jumping on the line right now. I can see the line is filling up with self-directed investors, and we are here this afternoon to specifically discuss and teach about how to become a successful and confident self-directed private investor. I'm also on the line with my good friend and my business partner, Glenn Lytle, who's going to be joining us today and maybe jumping in a little bit. I'll be doing most of the speaking and teaching today, but in the past we've done some calls, some live calls, just like now. We're live right now. For all of you that are jumping on, it is Thursday at 4 o'clock Eastern Time, 4:01 and a half on my watch. I just had the idea basically 2 days ago, if you guys got my email, about 1 in the morning, that, we have a pretty large demand for students of ours who have money in their self-directed retirement account or have cash on hand, and they're not really quite sure what to do with it. Matter of fact, I had a coaching call this morning with one of our high-end coaching students. His name is Luis de la Cruz, and he and I were, basically putting together his financial plan for him. I met with him earlier today at about 11 o'clock this morning, and Luis has, saved a lot of money in his pension and his 401k, his retirement account, and he wants to make additional money in his retirement account. And so we're sort of wargaming and talking about what his different options are as a self-directed investor. And so I have not delivered this training before, and so I have a bunch of stuff prepared, but I'm going to be adding to this mind map as we go. So if you hear me kind of typing on the keys on my keyboard, just bear with me. And one of the things we're really trying to do today is really two things. Number one is I am thinking about creating a training class or a training course specifically on this topic of how to be a successful and confident self-directed private investor, okay? Whether it's, buying real estate in your self-directed accounts, whether it's loaning on real estate in your self-directed accounts, whether it's buying tax liens and tax deeds in your self-directed account, or whether it's even buying stocks, bonds, mutual funds, silver and gold bullion, whether it's buying into private equity offerings or commercial real estate, whether it's buying oil and gas leases or anything that's non-traditional, right? So the first question I have, and we're just going to use the GoToWebinar chat box today, and I will export all the comments out of the chat box after this call is over. So my first question is, how many of you think that if we put together a training course, whether it's a class or a live webinar or a live event on how to be a successful and confident self-directed private investor, how many of you would be interested in learning that? Right? So if you can go into the GoToWebinar chat box and tell me, yes, I'd be interested in learning that. So I'm sort of assuming that you guys all have some money, right? Maybe 20 grand, maybe 200 grand, maybe 2 million, whatever the number is, that you have some money and you want to successfully deploy that money and get a really good interest rate. So how many of you would be interested in learning more about that? Okay, yep. So Raul, Rich, Becky, Rick Bray, Sue, Daphne, Jim, Michael, Phil Parker, Wayne and Maggie. What's up, Wayne and Maggie? How are you? Wayne, our call earlier got cut off. So I told Kurt and Jason to reschedule us for another 15 minutes. William Turner, Pat Hughes. What's going on, Pat? How are you? Tom Lopez, Carlos, Rich Mylot. What's up, Rich? Thanks for jumping on. Okay, very good. Okay, so yeah, bunch of comments in the chat box. Okay. All right, and so yeah, this is obviously a training where a lot of people come to us for real estate education and they want to be active real estate investors, okay? So they want to be active versus passive. And obviously, to be a passive investor, you have to have some of your own money, right? So what I call an active investor is somebody who's a flipper, somebody who's a landlord, somebody who's a wholesaler, somebody who is actively doing deals to create what I call current income, okay? Current income into their life, into their business, so they can pay today's bills, okay? Or save for an upcoming event, maybe like a wedding for their kids, maybe education for their kids, maybe their own retirement, okay? They're actively growing an account to pay today's bills or to save for an upcoming event, okay? In addition, they also might just be trying to build themselves some security, right? Having a nest egg, having some money set aside. That's an active investor. A passive investor is somebody who already has some money saved and is simply trying to get the best yield they can, okay? The best yield they can in a responsible manner, okay? So not somebody who's reckless, somebody who's just, buying whatever they can, in order to make money, but somebody who has some money, whether it's in a self-directed IRA, or it's cash on hand, or a brokerage account, okay? Something like that. That's a passive investor. Okay, so how many of you just want to be a passive investor only? Okay, again, go into the GoToWebinar chat box and let me know. Let me know if you're maybe already retired. Maybe you're sitting on a nest egg and you want to responsibly get the best yield you can. Okay, how many of you think I just want to be passive? Okay. Or if you want to be just active, okay, if you just want to get active income, you want to buy properties and flip them for cash, you want to be a landlord, you want to be a wholesaler, you need current income. So if you could go into the chat box and just say, yes, I want to be an active investor. Okay. And how many of you would like to do both? Okay. Okay, so already we got a bunch of comments. Andre wants to do both. Jose wants to do both. Daphne wants to do both. Jennifer says I'm active. Phil says I want to be passive and active. Thomas says I'm active for now. I have 3 young kids. Hey, Tom, welcome to the club, buddy. Welcome to the club. Looking for both, Wayne and Maggie. So you all have, Ron Jackson says both. Carlos says both. Jennifer, Amos says both. Rich says I want both, but I'm active for now. Okay, very good. Okay. Well, that's helpful, guys, because sometimes we have over 300,000 email members and subscribers. Sometimes it's kind of hard for us, to be honest with you, to kind of segment who wants what, who wants training on passive income, who wants training on active income. And so what we'll do after this webinar is over is all of you that said and responded in the chat box, I'll probably have somebody from my customer service department reach out to you for 10 minutes and just get to know you a little bit better and get to know what it is that you're searching for. Because my job as a CEO is to simply create products and services and trainings that meet the needs of my members. It's really easy. I ask my people what they want, and I try to give it to them, right? It's the easiest way to have sort of raving fans is to ask them what they want and then give it to them in a very fun, interactive, engaged experience. That's what we're here to do. Okay, so let's talk for a second, and let's jump right into today's training, okay? Let's talk for a second about how investors are currently consistently earning 12 to 17% passive returns being the bank for active real estate flippers and investors. So for those of you that are active or those that are passive that responded both, this is for both of you, okay? So I'm going to walk you through two case studies. One of them on Oak Lawn Drive, right? Okay, actually this is, I'm sorry, the one on Oak Lawn Drive is brand new, and the one on County Street is also brand new. So I don't know, we might have, you know, the borrowers who are borrowing this money on the line right now. So these are two deals that we've just recently closed. We underwrote, we originated, and we gave the loan to one of our borrowers just in the last 30 days. Okay. Oak Lawn, we literally just closed last week. Okay. And County Street, 682 County, we closed about a month ago. So these are two brand new deals. Now let me tell you why we closed these deals, why we decided that we wanted to use our money and close these transactions and make these loans to our students. Okay? So number one, purchase price was $60,000. Rehab amount, $72,600. Okay? Purchase price plus rehab was 65% of the after repaired value. The after repaired value was appraised, okay, by a certified appraiser, certified licensed appraiser at 204. Okay? Purchase price of 60, rehab of 72, after repaired value appraisal at 204. So let me give all of you active investors a tip. If you want to recruit more private money and you find a deal like this on Oak Lawn Drive and you package it up, and what I mean by package it up, what I mean is create a one-page summary. Okay, we call them funding opportunity sheets. Okay, and some of you have seen our funding opportunity sheets come out over the last 6 months. Now, we looked at the purchase price of $60,000. We looked at the rehab budget of $72,600. We looked at the purchase price, and rehab was at 65% of the realistic saleable after repaired value. And the after repaired value came in at 204 by a licensed certified appraiser. And so the loan that we made was $145,283. And we closed that loan on our own line of credit. So we own that loan right now. And that loan is a loan that we will sell to a private investor like all of you, or we'll sell it to our fund, we'll sell it to our private equity fund, or we might sell it to an institutional investor. Okay? Now the reason why this is a good deal for everybody, for the borrower, for the investor, for us, of course, is the numbers. Purchase price plus rehab 65%. We have a licensed certified appraisal at 204. Okay? So if you're a borrower, if you're on the active investor side and you want to recruit more private money, what I would suggest you do is you create a one-page funding opportunity sheet that has all the details. Right? This should have about 6 pictures of the house. Okay? It should have the purchase price. It should have the rehab budget. It should have the after repaired value. And if you are looking to borrow money, don't be afraid to order your own appraisal and then present that appraisal to the funding partner. Okay? Now, if you are a funding partner and you are looking to deploy some money that you have and you want to get a 12, 13, 15, 17% return, you should be looking for this information. You should be looking at your potential private lender, your private investor. You should be asking free land, if you're going to be investing with us, you should be asking for this stuff. Okay, show me the purchase price. Show me the rehab budget estimate. Show me the appraisal. If you want to see the appraisal, we can show it to you. Okay? So it depends on which side of the table you're on. If you're the borrower, it would be really easy for you to recruit money by presenting this package to a private lender. Okay? And what I do as a borrower is I pay my investors 12% interest or 15% of my profits, whichever is greater. That's what I do through my own private investments that I make in Northeast Ohio, where I'm an active investor. And that formula seems to work really, really good. Because people like the idea where their downside, their minimum, is 12% interest. Okay? That's almost like getting 14% in the stock market. Okay, because the stock market has expense ratios, okay, and commissions. And expense ratios and commissions eat into your return. So if you got 14% fixed in the stock market, would you be happy? How many of you guys would be super happy if you got 14% in the stock market? Right? Everybody would. All right? You can't get that in the stock market, unfortunately. Hey, sorry to bust your bubble. Pop. Sorry to bust your bubble. Can't get it. Can't do it. Can't get 14% fixed. No way, no how. There's no stock. There's no dividend. There's no mutual fund. There's no bond that pays a 14% coupon rate. Sorry, doesn't exist. Even junk bonds don't pay that. Okay? All right. Same thing here with County Road, 682 County Street. This is another deal where we looked at the borrower, and I'm going to tell you in a minute exactly how we underwrite, so that for those of you that are passive investors, you can learn a little bit more about how to appropriately and responsibly underwrite a file that you would lend on or you would buy in your self-directed account. So I'm going to literally pull back the curtain and show you exactly how we underwrite files so that you can do it too. How many of you guys would like to see that? How many of you guys would like to see that? How many of you guys would like to see exactly how we underwrite files and what we look at so that if you are looking at being a passive investor, that you can do a better job of reducing your risk? Okay? And also, if you ever decide to invest with Freeland, right? If you decide to invest in our private equity fund or on one of our one-off deals or whatever, you'll know the method that we use to underwrite deals. So you can become more comfortable with us if you decide, instead of you doing it yourself, just let us do it for you. Sort of a done for you. We'll package it up for you so you'll know exactly how we do it. Okay, so let's talk about County Street. Okay? County Street is in Massachusetts, and Oak Lawn was in Virginia. All right? So County Street, purchase price of $125, rehab budget of $26,800. We made a loan of $156. Okay? So we rolled all the closing costs, the points, fees, okay, the underwriting fee that we charge into the loan. Okay? So again, you see here, purchase price plus rehab at $125 plus $26,800. Okay, was 68% of the after repaired value. After repaired value came back at $221. So I know a lot of you guys have heard me say 65%, 65%, 65%. Well, we're not gonna cut the deal off if you're at 68%. Okay, close enough. It's a good deal at 68%. We made this fellow a loan at $156. Okay. I'm sorry, actually, I got the number wrong. I'm sorry. Let me just fix this real quick. I had a typo here. The loan that we made was actually $160,272. Okay, sorry about that. $160,272. So the after repaired value is $220. So this investor has about a $60,000 spread between the loan and the after repaired value. So he's got money to pay for his monthly interest-only payment. He's got money to cover closing costs and realtor commissions. Okay, and with his purchase and rehab at 150, the ARV at 221, he's got $70,000 of spread there. Okay, would you? Let me ask all of you: would you do that deal yourself? Hell yeah, you would. Would you lend on that deal and lend the guy the money? Hell yeah, you would. Okay, so those are a couple examples. Now, how are investors earning 12 to 17% or more passive returns being the bank? Well, when you see how we underwrite files in just a second, you'll see how owning notes and mortgages against real estate allows you a lot of different methods to charge points, to charge interest rates, to charge underwriting fees. And when you're the bank, you get to dictate that. When you have cash, you get to dictate that to the borrower. Okay? So there's lots of good people out there looking for deals. And they find a good deal, and then they're looking for money. Well, if you have money, you can structure it where you can get a point or two up front. You can get 11, 12, 13% fixed interest. Maybe get another point on the back end, or even a profit share on the back end. Okay? So let me show you exactly what we do to underwrite a file. Okay? So the points, so your interest, your total interest earned is the sum of, okay, the points you charge up front, okay, the interest, the points you charge for extensions, okay, and your back-end profit share if you get a back-end profit share. Okay? For me, what I do, again, is 12% interest or 15% of my profits, whichever is greater. There's no points. Okay? And it's one or the other. Okay? No points, no extension fees. Okay? And also, all the interest is paid at the end. That's on my personal deals. Okay, I know a lot of you have asked me, like, hey, Josh, I got an extra 200 grand. Can I fund your deals? Can you fund my deals? The answer, unfortunately, is no, you can't. Okay, I have too many people sort of in my inner circle that fund my own local deals. And so anybody who wants to invest with us, has to invest through Freeland Ventures, Freeland Fund, or through Freeland Lending. Okay, but through my own personal deals, it just gives you an idea. Okay, so let's talk about underwriting. Let's talk about reducing risk. Okay, let me walk you through some of the things that we do. So when we receive a loan application from you, if you're an active investor and you're a borrower, okay, this is what we do. Now, if you are a passive investor looking to underwrite your own files for your own capital, this is what you should do. Okay, and if you don't want to do all this crud, then just invest the money with us and we'll do it all. Okay, it's sort of done for you. All right. So when we get a loan application that comes in, okay, so let's just talk about the loan app for a minute. Okay, the loan app obviously covers stuff like first name, last name, email, phone number, physical address, subject property address, all that stuff, all the basics. Okay, but then they also check the box to authorize Freeland to pull credit. Okay, and we pull credit from one bureau. So I'm sort of typing so fast here I can't even spell. How do you spell bureau? Something like that, right? Hey, I got it right. Okay, there we go. So the important thing here is that the borrower checks the box to authorize free land to pull credit. Okay? And so for you as a passive investor, one of the questions that you have to ask yourself is, are you going to pull their credit? Okay? Now, I don't even allow my private lenders to pull my credit. I have an 800 credit score. I don't let them pull my credit because I don't want the inquiries on my credit. And also, I'm good for it, if you know what I mean. You know, I have assets and I have lots of money, and you know, I don't say that to brag. I'm just very fortunate, and so I don't need people pulling my credit to verify whether I'm a good borrower. But again, if you are on the borrower side and you want to prove that you're good for the money, you can allow your passive investor to pull your credit. That's one way to give them more confidence. So that's a big part of the loan application, is the ability to pull credit. Okay? Now also on the loan application, tell us about the funding opportunity. If you're the borrower, tell the private lender, the passive investor, about the funding opportunity. Sell me on the deal. Tell me why you're going to buy it at the purchase price you're buying it at. Tell me what the rehab is. Tell me why the neighborhood is awesome. And if you're a passive investor and you're looking to underwrite a file for your own money that you're going to invest in a deal, have the borrower, or what we call the sponsor, okay? The borrower is also known as the sponsor. Have the sponsor sell you on the deal. Tell me about your deal, okay? Send me the pictures, okay? Tell me about the after repaired value. Sell me. Sell me. Pitch me. Okay, pitch me. All right, it's like that movie Boiler Room, when the guy's selling stock, but that one ass Saturday afternoon, he's sitting in his pajamas, he's reading the newspaper, and the guy calls him up and asks him if he wants to buy the Post, right? You guys that have seen the movie Boiler Room, you know what I'm talking about. Sell me on why I should buy your newspaper. Sell me on why I should lend you the money. Okay, so again, if you're a passive investor looking to fund a deal, you should ask for a funding opportunity sheet. Give me the summary of why I should do this. Okay. Now, once we have all of this material in, okay, we need a copy of the purchase and sales agreement. Okay. We also need what we call the Rehab Budget Estimate Guide. The Rehab Budget Estimate Guide is, again, a summary of the work to be done. It's a scope of work. Okay? How much work are you doing? What kind of work are you doing? Or how are you doing the kitchen, the bathrooms, the roof, the siding, the landscaping? Are you doing, Formica countertops? Are you doing granite countertops? Are you doing hardwood floors? Are you doing laminate floors? Are you doing carpet? Are you doing real hardwood floors? Are you doing slate floors, marble floors? What kind of finishes are you going to put into it? Is it a 3-bedroom, a 4-bedroom? Okay? The Rehab Budget Estimate Guide tells a story. So again, if you're a passive lender, ask for the story. Tell me about your scope of work. How long will the deal take? Okay? Guys, I listened to Kevin O'Leary do a keynote speech about 1.5 years ago. I was at a business development and marketing conference, and Kevin O'Leary from Shark Tank spoke. He said, as an investor, your number one concern shouldn't be how much yield am I going to get. Your number one question should be, how safe is my principal? When am I going to get my principal back? And I agree with that. The number one question, okay, is not yield. It's when am I going to get my money back? Okay? Now this brings me back to, again, my own deals and the freeland deals. On my own deals, okay, they're just 1-year loans with a 1-year balloon. Okay? So my investors know they're going to get their principal back within 1 year or less. Often in 4 months or 5 months or 7 months. Okay, depending on how large my rehab budget is. But again, when am I going to get my money back? If you're a passive investor and you're looking for yield, that's great. But ask the most important question, which is, when am I going to get my principal back? The second question is yield or return. Okay? And the third is how. How are you doing the deal? How? Tell me about the deal. For those of you that watch Shark Tank or the show The Profit, I love that show The Profit with Marcus Lemonis on CNBC, right? Right? I'm currently vetting out a whiskey company that makes whiskey. I'm actually considering buying shares into a whiskey company. My first question was, when am I going to get my money back? My second question is, what's my return potential? And third is, how are you going to do it? Tell me about your business plan. Same thing with real estate. Okay? All right. So all that comes in the loan application. Then the next thing we do is we look at Google. We look at the street view of Google. And we look at the area that it's in. We're not really looking at the inside of the property. What we're looking at is boarded up houses. We're looking at graffiti. We're looking at the neighborhood. We're looking at busy streets. Okay? That's most important to us, is just tell us a picture of the neighborhood. Okay? What we're mostly looking for are the neighbors well kept. You know, are we looking for houses that are boarded up? We see any of that stuff, it's deal's done, forget it. It's over. No chance. No chance. Okay. Okay. Next is we have a program called Home Facts. Home Facts carries a lot of information. A lot of info. It tells us about the crime rates. It tells us about the school districts, the rating of school districts, and tells us about unemployment rates in that neighborhood. Okay? We prefer to have something that has at least a C+ or a B- crime rate. School districts that are rated at least a 6 or a 7 or an 8 out of 10. Okay? An unemployment rate at 8% or less. Okay, you guys catch those figures? Crime rate at a C+, B- or higher. Schools at a 6, 7, 8 out of 10 or higher. And unemployment at 8% or less. Is that helpful? All right, very good. Okay. The next resource that we use, believe it or not, is Trulia. Trulia, now we specifically look at Trulia because Trulia has a block-by-block breakdown of crime. You know, a lot of people, when there's areas that are, you know, regentrifying, areas that are getting better, areas that are turning over, it's tough to tell which areas are in the hood and which areas are regentrifying. Okay. All right. So when I talk to Mark Grecker, who's our processor, he's looking at Trulia on a block-by-block breakdown of crime, war zones versus safe areas. Okay? If we see anything where there's significant crime and where there's, you know, what we call capital crimes, you know, a significant amount of drug traffic, murders, rapes, you know, violent crimes, we're staying away from those areas for sure. Zero chance of us doing a deal there. But I can tell you a story. I own a house in Tremont, Ohio, which is it's actually a city. It's a city of Cleveland, but it's a neighborhood in Cleveland. And Tremont is very hot, very expensive. All kinds of restaurants and art galleries. And sure enough, like in the same zip code is the hood. Same zip code. And so that's the challenge that we have as an underwriter, and that's the challenge that Brian Stark and that Mark and Ryan, myself, and Glenn that we have at Freeland is identifying those areas that are in the gray area, that are on the border. So if you're a passive investor and you're thinking, how am I going to identify whether this is in a good area or not, check out Trulia.com. Specifically look at their map view and look at their block-by-block breakdown of crime. Okay. So again, crime rates, for those of you taking notes, crime, C+, B- or better. School districts, 6, 7, 8 or higher out of 10. And unemployment, 8% or less. You know, they say the unemployment rate now in the United States is at about 6%. Okay, so 8% or less. All right. Next, of course, is you're going to look at comps. You got to look at comps. The house has to comp out. And there's a lot of different resources you can use for comps. Okay? For a second, let's just look at Zillow. Okay? Let's just look at Zillow. Now, again, I'm going to bring up a property here. Is a property that we just recently bought, my brother and I. And I would just use this as an example. This is a property on your screen at 3665 Brookside Drive in Norton. Okay? You look at the picture, sort of looks like a country property, right? It is a little bit in the country. All right? You see the side of the house, it's got paint on it. All right? The inside of the property is yellow. Brand new kitchen we're putting in it. It's got a fireplace, not bad. It's got this, you know, utility area. All right, that's all fine. Sold for $62,000. That's what we bought it for. Okay. Now, what I'm looking at down here, if you scroll down, now I'm looking at Zillow. I'm looking at the nearby similar sales. Okay. And I can click on this button that says see sales similar to 3665 Brookside. And this opens up a whole slew of potential comps. And again, Zillow's not perfect, but it's a resource. Okay? And what it tells us is it plus or minus one bathroom, plus or minus one bedroom, plus or minus a square footage. Okay? And these are all sold comps. So these aren't, you know, projected. These are sold. Now, the other thing I like about it is look at this map view. It shows us the property, the subject property in green, and then all the comps in yellow in a map view. Okay? So that's nice. So again, if you don't have access to any sort of exotic, expensive comping software, Zillow will show that to you. Okay? And you can see from these comps, just from these little pictures, you can tell these are decent properties in decent areas. You know, the front yard is well kept. There's no houses on, you know, or there's no cars on blocks in the front yard. Okay. These are listed by realtors and selling for a decent price. Okay. All right. So that's a resource that we're using, that you should be using if you're a passive investor. Okay. You can also look at resources like CoreLogic and Realty Track that also are very similar to Zillow. All of these resources, guys, they all pull their data from public record. They're all getting it from the same place. It's just how they package it that's different. Okay? Now, one of the really the best resources to use is RealQuest. RealQuest has a national database that shows properties, again, pulls all their data from public record, but it's a lot of detail, has the best filters, it pulls property tax values, it tells us if the property taxes are current or behind on a property, it tells us the taxable value for the, you know, in that local county, what's the tax value. So really the kind of the holy grail of comp software is RealQuest. Okay? That's going to tell us primarily properties that are sold. So if you want to do all your comps based on sold properties, you want to look at RealQuest. Ideally, if you want to look at properties that are actively on the market, you would look at the MLS. Okay? So one of the things you could ask for as an active, as a passive investor, is to tell whoever you're lending to or whatever deal you're looking at lending on or investing in, okay, ask for a current market analysis from the MLS. Now, a current market analysis is made up of three things: 3 sold properties, 3 active properties, and 3 pending properties. 3 active, 3 sold, and 3 pending. Of course, what we're going to look at primarily are the solds. All right? So Rich says, hey, where can I find the mind map for this presentation? Hey, Rich, I said at the beginning, this is a brand new presentation. Again, I created this mind map literally starting yesterday morning at 1 a.m. At 1 in the morning on Thursday morning, I got the idea to do this presentation, literally less than 48 hours ago. And I built out this mind map yesterday and today, and I'm continuing to build it out. So it's not available anywhere. Okay. Moses McCown says, hey, what about local police sites for crime rates? Okay. It's not a bad idea. Moses, it's not a bad idea. We're not going to go to every little local police website and hunt down local police websites to find crime rates. You know, we're looking for more of a national solution because we're lending across the United States. Okay, so next piece of the underwrite is the rehab work. You know, and again, we require our borrowers to fill out the rehab budget estimate guide. Okay, when I talk to my private lenders now, you know, because we know what we're doing, all right, and because we've been doing this for a long time, my investors don't ever really ask. Okay. My investors don't ask, you know, hey, give me a breakdown of your rehab budget. They don't ask. They just want the total. It's going to be 42 grand. Okay, cool. They trust me because we have a track record. But if you don't have a track record and you're an active investor, you need, again, to fill out the rehab budget estimate guide and tell us a story. Now, what we do as an underwriter reviewing these deals, and what you should do if you're a passive investor, is look at the rehab budget estimate guide, look at what they have and what their scope of work is and what their schedule is. And if you need to, call the rehab contractor. Call the contractor to verify the rehab budget, the schedule, and the scope of work. Okay? The rehab budget, how much? The schedule, what's going to be done and when? What's going first, second, third, fourth, fifth? Okay, and the total scope of work. Okay? My brother and I, we use what are called Gantt charts. Okay, Gantt charts are basically process-driven charts. What are we going to do in the first week? What are we going to do in the second week? What are we going to do in the third week? What are we going to do in the fifth week? What are we going to do in the 8th week? And we lay it out. And if our investor that wants to fund the deal wants it, I'll happily give it to them. So again, if you're a passive investor, you might ask the borrower and say, hey, show me your scope of work. Tell me what's going to happen and when. Now, finally is the appraisal. And this is, for sure, the most important piece. Okay? First of all, appraisals are not always accurate, but normally they are, but not always. And one of the things that we make sure that we do, and one of the things that you should make sure you get as a passive investor, is make sure that the appraisal, okay, and verify that the appraisal is an after repaired value appraisal. Make sure it's an after repaired value appraisal. Okay, you believe it or not, sometimes we order an after repaired value appraisal and they send us an as-is value. Sorry. Redo it. Okay, so again, if you're a passive investor, make sure it is an after repaired value. Phil Parker, my buddy Phil's on the line with us. Phil is a licensed appraiser. And Phil writes in the chat box, it's a professional opinion of value. Right? That's exactly what it is. It's a very clear and easy kind of way to describe it. It's a professional, but again, it's an opinion of value. All right? Professional opinion of value. It's not always accurate, though. So what we do at Freeland, and my buddy Brian Stark is responsible for this, is he literally reads the entire appraisal line by line. Literally. The whole thing, line by line. And so what we're basically doing is we're comparing our professional opinion of value to the appraiser's professional opinion of value to the borrower's professional opinion of value. And we're all just trying to get along. Trying to agree, right? Phil Parker says, I hope Brian has good glasses. Okay. Okay. All right. And so Brian reads it line by line. Sometimes, do we agree with the appraiser? Do we agree with their assessment? Do we agree with the work? And we want to make sure, right? I was talking to Mark Recker earlier today about this, and he was so adamant about this. We have to make sure that the rehab budget estimate guide is attached to the appraisal. So if you're a passive investor and you really, really want to do your homework, make the borrower pay for an appraisal, but you as the lender or investor, you order the appraisal. You order it from a third party. Do not tell the borrower who you're ordering it from. Make sure it's a third-party appraisal. But make sure that the rehab budget estimate guide is attached to the appraisal. Why? Because let me tell you what happens sometimes. Borrowers send us a rehab budget estimate guide, and let's say it's $42,000. And then when we get the appraisal, there's a different rehab budget estimate guide that's for $51,000. And so the appraiser is looking at the rehab budget estimate guide. That's what's helping the appraiser formulate his professional opinion of value. So if he's looking at a rehab budget estimate guide that says $51,000, that's going to affect his opinion of the after repaired value. Okay? If he had a different rehab budget estimate guide that said the rehab was going to be $36,000, that would influence his opinion of the after repaired value. So make sure that the rehab budget estimate guide is attached to the appraisal so that you know that your opinion of value is based off of the same rehab estimate. Okay? So those are all the things that we look at. Those are all the things that you should be looking at. So how do we manage risk? How do we manage risk as a private lender or an investor, and how should you manage risk as a private investor or lender? We call these the 7 pillars of risk management. Okay? So number 1 is low loan to values. And what I mean by that, again, is purchase price plus rehab, 65 to maybe 70% of ARV, okay? And loan to value, again, because we're baking in some fees into the loan to value, is going to be about 68 to 74% of ARV. Okay, you understand, purchase price plus rehab does not include any of the fees. So number 1 is low loan to value. Number 2, make sure you get first mortgage or first trust deed position so that you can foreclose. Okay? And also preferably no second mortgage. Okay, preferably no second mortgage. Now sometimes, again, when I borrow money, I have a first mortgage. Maybe some guy's got 100 grand, but I need 140. So first mortgage at 100 and a second mortgage at 40,000. So preferably no second mortgage, but again, when you're doing private deals, sometimes you can do a second mortgage, and that's okay. Okay. Number 3 is make the borrower have some skin in the game. All right? So we require monthly interest-only payments. And for you as a private lender, a passive investor, are you going to require the borrower to make a monthly interest-only payment? You should. Okay? Unless you're lending to a guy who's got a lot of experience, like me, or like some of our Maverick Mastermind students, or some of the people that have a lot of experience on the line, then you can defer all the payments and all the interest to the end. Okay. Number 4, another way that you can manage risk is by holding back the rehab draw. Again, make the borrower have some more skin in the game. Hold back the rehab draw and make the borrower pay for some of the rehab out of their own pocket, or make their contractor pay for some of the rehab out of their own pocket and then reimburse them out of your funds. Okay. Number 5, order an appraisal by a third-party appraisal service. Okay. The appraisal services that we use is myappraisalinstitute.org. Write that down. myappraisalinstitute.org gives us a list of appraisers nationwide. And then we call those appraisers directly or order a third-party appraisal. Okay. Another appraisal service that we use is called Order Pro USA. Okay, it's called Order Pro, which is an appraisal management company. Okay, so again, if you're a passive investor and you want to make sure you get a true third-party appraisal done on the property, you really want to protect your money. Okay, there's two resources for ordering appraisals from a total third party. Again, the borrower should always pay for the appraisal. The investor or the lender should always order it. And the borrower should not attend the appraisal or influence the appraisal. With Order Pro, you can log into their website and you can click a button to order an appraisal. Okay. Number six, sixth pillar of risk management is you should have regular site inspections done. We use a program called We Go Look. They take pictures, they take video, and they actually narrate the video. Okay. They can oftentimes get there and perform the pictures and the video in less than 4 days. So again, if you want to triple check that you're lending on the right property, if you're lending virtually in a different state, okay, make sure you have somebody go look at the property like We Go Look. They're a professional inspection. They're not house inspectors, but they are like an inspection company that just kind of goes out and checks up. Now, they're not going to tell you how much work the property needs, how much repair is done, but they will go in and narrate what they see and take videos and picture. Okay. And the seventh pillar of risk management, number 7, is to have a plan B, a plan C, and a plan D in case something goes wrong. Something goes wrong, can you foreclose quickly? Okay. Can you do a deed in lieu? Okay. Can we put it on the market and just sell it on the MLS? Okay. Can we do a deed in lieu and quickly wholesale it to somebody else? Okay. Maybe we just take it back and rehab it ourselves and make a profit. If you are a passive investor, you want to know what's your exit strategies. What are the things and the strategies that you can deploy to get your principal back? Plus, hopefully, all your interest that you're due as well. Okay. So those are what we call the 7 pillars of risk management. Now, in addition, you could really call it 8, because what we do is we do a full underwrite. Okay, which I just went through. And actually, the other thing I didn't even really talk about over during the underwrite is the financial underwrite. Shit, I didn't even talk about that. Sorry. I told you I didn't have this all buttoned up ahead of time. I was kind of building this as we go. But the financial underwrite, right? So pull credit. Okay. The big question is, how are they going to afford the monthly payment and the rehab? Okay. What is their financial backup in case the deal goes sideways? Okay. What's the plan? The financial underwrite. Okay. Again, that's part of our loan application where they tell us a story in the loan app. What's the summary? What's the scope of work? How are they going to afford it? If you're a passive investor, the financial underwrite. Okay. Again, we're not doing a full financial underwrite like a traditional bank. We're not asking for pay stubs and tax returns and bank statements, but we need proof that they have the funds to be able to afford a monthly payment and for the rehab money. Okay? So for us, I guess you could call this an asset-based financial underwrite. Okay? Does that make sense? So I'm in the emails that I sent you to invite you here, these are some of the things that I talked about, right? How these secured investments and loans at low loan to values ensures profitable exit strategies. Well, if it's underwritten appropriately up front, the borrower makes their money when they buy, and you as an investor, a passive investor, you protect your money at the purchase. Okay? Now, why simple, in my opinion? Why does simple always outperform exotic? Guys, I see all kinds of exotic investments and buying businesses and buying commercial businesses and doing land deals and development. And what I don't like about it is this. In an exotic deal, it's if this, then that. If this happens, then that happens. If this happens, then that happens. And if we get the permits, then we do this. And if we, again, this whiskey guy, right? If he gets this money, he can make more whiskey, he can speed up his fermenting process or whatever. It's a guess. Exotic equals a guess. It's a hope. Okay? It's on the if come. I don't like any of that stuff. To me, simple equals predictable. Does 2 plus 2 equal 4? Does 4 plus 4 equal 8? Okay? Does, in the case of real estate, like this deal on Oaklawn, does 68,000 plus 72,000 ultimately equal 204,000 in the after repaired value? Okay? That's what I want to know. Is it simple, predictable, straightforward? Do I get it? Remember, you have to answer the question. When am I going to get my money back? How am I going to get my yield? And then what is your business plan? If you're a borrower and you come up with all these exotic ideas of how you're going to do X, Y, and Z, dude, forget it. Deal's dead. Nobody's going to fund that shit. Okay. So when do you say no to a private investment opportunity, right? When your purchase price, if again on a rehab, okay, on a rehab, when your purchase price plus rehab is over 70 or 75%, okay, on a rental, okay, if your purchase price plus rehab is over 80% on a rental, okay. If your days on market is twice the average, okay, if you're talking about properties that need 120 days or more to sell, and if your market area, your MSA is below 100,000 people, not doing it. And again, understand what's plan B, what's plan C, what's the exit strategy. If they say, I'm going to buy this property, fix it, and I'm going to refinance it, well, what they're basically saying is, I need a refinance loan. Do they have the credit to get market rate rental financing? Okay. And so my question is, why would anybody invest in the stock market? It makes no freaking sense. It's not predictable. You have all kinds of uncontrollable forces, like political forces. Okay, you have international forces, like what's going on in China, what's going on in Europe. I don't get it. Okay, you have Fed policy, uncontrollable, that all affect the stock market. I don't get it. I'd rather take an asset that I can look at, that you can look at and say, this is what it's worth if it's fixed up, because the house down the street and the next house down the street and the next house after that, they're all worth the same. Simple. Okay? And so I talked about how we would show you guys some new funding opportunities from Freeland Lending. where you could earn 13% fixed passive returns. You know, I didn't have a chance to put a bunch of them together, but this deal on Oak Lawn and this deal on County are two deals that we just closed. Okay? If you want more information, again, we cannot sell and solicit securities to the general public. That's not what we're doing here. But most of you on the line, we already have a prior existing relationship with you because you're already a 40K flip student. You're already a Freedom Funding member. You're already a high-end coaching student. You already own our products and services. You've attended webinars. You've attended our live events. So what we need to do is convert that relationship from a student relationship, a borrower relationship, into an investor relationship. And so if you're interested in learning more about what we do and how we can give you done for you, right, done for you, private passive investment opportunities, okay, fill out our survey, which is www.freelandlending.com/survey. Okay, also, we have your comments and questions in the chat box. We will follow up with you. We will contact you, but fill out our survey, freelandlending.com/survey. If you want to work with us more tightly, consider investing with us. We have to do a one-on-one strategy session with you, potentially several one-on-one strategy sessions with you, okay, before you can invest with us. Now, the last thing I want to talk about is what we call the rule of 72. Okay, the rule of 72 is very simple. The rule of 72 is you take the number 72, okay, and you divide that by your interest rate. And the ending number is the total years it will take to double your money. Okay? So if I have 72, and if I divide that by a 13% return, okay? If I take 72 and divide that by 13, I'm going to double my money every 5.5 years. Okay? So let's just say you have just $50,000. 5.5 years from now, you'll have 100. 5.5 years from now, you'll have 200. 5.5 years after that, you'll have 400. 5.5 years after that, you'll have 800 grand. Now, just keep in mind the stock market, all it can offer you is about, over the long term, about 9% is the stock market return over the last 100 years. Okay? And not only that, but you have expense ratios and commissions that you have to pay. So one of my buddies who is investing with us in Freeland, I'm meeting with him tomorrow, his name is Brandon. Brandon is a financial advisor. He sells stocks and bonds and mutual funds. But you know what? He's investing in Freeland because he knows on the long term, you're going to get about a 9% return in the market. And after your fees and expenses and commissions, you're going to get about 7%. And that's what Brandon told me last week. And he's a financial advisor. Okay. So he's investing with us, with some of his capital, to diversify his portfolio. So guys, this is, again, what we do. This is what you should do if you're looking to really put your money to work in a very smart way. You should mirror and clone what we do at Freeland if you're going to make private investments. If you want us to do it for you, hey, that's why we're here. We'll do it for you. Okay? If you want more information, visit freelandlending.com/survey. Now, before I let you all go, all I want to know is, was this class helpful? Rich says the no buzzer noise is funny. All right. Was it helpful? Fantastic. So, you know, Paul says very helpful. Rich says yes, it was. Maggie says it was. Marco says it was awesome. Jennifer Frederick says thank you so much. Okay, Phil Parker says very helpful. So thank you. If you've made comments in the chat box, okay, and you want more information, We will be giving you a call probably in the next 4 or 5 business days or less, okay, just to figure out how can we help you put together your financial plan, whether it's as an active investor or a passive investor or both, okay, just like I did with Lewis this afternoon. And we will think about and consider moving forward whether we put together a product or a training or a coaching or a live event on how to be a successful and confident self-directed private investor. I look forward to putting that together, maybe talking about tax liens and tax deeds, and talking about options or stock market investments that are a little bit more creative, okay, like puts and calls and options and stuff like that. Okay, maybe talk a little bit more about muni bonds, okay. It's something I look forward to potentially doing with our investors that want to be passive and really want to manage their money. I look forward to putting that together. So guys, that's it for today. I got to go coach soccer. I'm on my way out the door to coach my girls at soccer. We're undefeated, right? We're 5-0-1. We haven't lost yet. We got 1 tie. We got 2 games left. And so I want to thank everybody for being here. I appreciate all of your attention. Go out in the field. Be daring. Make it happen. We'll talk to you soon. Take care.